everybody. This is Mark Weissy with Maple Capital Partners. And in the video today, we're going to be talking about how we process deals. That is, how do we underwrite the deals and what does our deal funnel look like? And so we're going to be taking you through steps A to Z about, when we first receive a deal in our inbox all the way through to eventually closing deals and everything in between. We believe, as do many in the market, that 2024 will offer an abundance of opportunities in the commercial multifamily space, and that you should use this time between now and then to really look at your deal funnel and your process for underwriting deals and making offers to make sure that you're able to process as many deals as possible. Next year, there'll be a ton of debt maturing, and that means more deals for all of us to potentially look at. So with that, we'll get started. So this is what our deal funnel looks like. This is what a typical deal funnel looks like, I should say. Those blue arrows you could take as different deals coming across your inbox. So that first step there, the red line, is whether or not the deal meets your buy box. We're going to dive into that. The next row down is going to be the first pass underwriting. In our case, we don't spend a ton of time doing our first pass. It's really just a sanity check. Does the deal pass a very high level underwriting? Does it pass a sniff test? And then from there, if it does, then it goes down into the next row, which is our deeper dive underwriting, where we're spending a lot more time researching the deal to make sure what is our price that we're willing to pay for this deal. Eventually, we're putting the offer in and hopefully closing more deals. Now, this funnel is called a funnel because it really does resemble that. The ratio that we've always heard in our upbringing in the multifamily space was you need to look at 100 deals in order to underwrite 30 that pass your first underwriting, for which 10 of them will actually pass your deeper dive underwriting. You'll make offers on 5 of them, and then you'll hopefully close on 1 of them if you're lucky. Now, today, that ratio is more in line with a higher number, maybe 200 deals that you have to look at in order for there to be one that really pencils that you make an offer on and ultimately close. So the first row here is developing a buy box. So what is meant by a buy box? It's really a set of criteria that you're able to communicate to your brokers and other investors to let them know what types of deals you're looking at. So we have a number of different criteria. Some of them are going to be spelled out here, one of which is the unit count. So you may have maybe focused on sub-institutional size deals, maybe sub-100 unit deals where you're much more likely to come across mom and pop sellers. You may have a purchase price that you're willing to pay per door or not pay per door, a certain year of construction or vintage of the property. So it's very common today for a lot of folks to look at only, say, 1980s or 1990s builds or later for insurance purposes, as well as upkeep and maintenance purposes. A lot of those older assets are really coming end of life in some respects. Also, the market. So if you're focused on a particular geography. Now, there are a number of other negative filters that you can also use to filter out deals, including some of the features of the property itself. So flat roofs, plumbing, aluminum wiring, foundations, all those different things may or may not dissuade you from looking at a deal. You want to include those in your buy box. Also, certain neighborhoods and submarkets of the particular market. So we mentioned that you may have a market focus, but even within that market, you may have certain neighborhoods that you're willing to and not willing to go into and invest in. So there are good and bad parts of every single city, and we think that that's really important to include in your buy box. Next is the level of CapEx required. So when you're starting off, you don't have a construction background, you may be a little bit more limited in terms of the scope of the CapEx that you're willing to take on. Whereas if you get more experience and start to do some of these deals with a little bit more hair on them, maybe you're comfortable with a little bit more CapEx. And you definitely want to make that known as you start to go out into the market and tell others about your buy box. I wanted to give an example here of what our buy box looks like today. We're focused on the 20 to 100 unit range. Also 1980s or newer vintage. We're focused on the Louisville Metro, but not the West End, and preferably east of Interstate 65. And we're also preferring non-crawl space or flat roof assets. We will look at them, but given the choice between 2 different deals, we will tend to prefer the one that doesn't have those features. Now, the top of the funnel, whether or not you're meeting the buy box in terms of the deal, is going to be filled with deals that you come across in a number of different ways. First and foremost is finding deals through brokers. You're going to get a ton of deals in your inbox from brokers. In our markets, in our experience, we've seen somewhere between 90 and 95% of the transactions happen through brokers. So that's going to be a really important set of relationships that you develop over time through consistent communication with those brokers, time spent in person with those brokers, and then also a track record of actually performing, doing what you say you'll do. Also, we have to make the distinction here between on-market and off-market deals. It's in quotes there, off-market, because realistically, it's very rare, at least when you're starting off, to come across true off-market deals. Typically, what you'll find is more likely is the broker who has the deal may show it it to their top 5, 10, maybe more end buyers, and see whether or not they care. And then, if there's no care anywhere close there, then they may list the property. But it doesn't necessarily mean that you're the only one seeing the deal. So that's why we kind of put a little bit of an asterisk on the off market. Whereas on market, that's typically listed, that's sent out to pretty much everybody on this broker's buyer list. And so you could think of that as publicly listed. Also, you'll tend to see a lot of those on market deals on some of the online platforms like Crexi or LoopNet. Also, regional sites like KCREA. In particular, KCREA operates in Kentucky, but there are a number of other examples like that in your market. So would definitely urge you to speak to other investors in your area, speak to other brokers about some of these online platforms that may be specific to a particular market. A lot of folks talk about Crexi and LoopNet as places where deals go to die. We definitely don't think that's the case. We know few investors that have come across deals that actually end up being really well-performing assets on LoopNet or Crexi. But I think when you're starting off, a really good use of Crexi and LoopNet is as a way to find actual brokers who are super active in a given market. So you can go on LoopNet, you can go on Crexi when you're first starting out, underwrite deals there, but more importantly, use those as an opportunity to reach out to brokers, make introductions, and figure out who are the real players in your market. Finally, direct to seller. We don't have a ton of experience with direct to seller, at least in the commercial multifamily space. There are a number of different ways that you can go direct to seller, including mailers, mailer campaigns, cold callers. You may have a VA do some of these things. Also, investor relationships in that given market. So as you build out your network in a given target market, you're going to come across a number of other investors there. It's really important to build relationships with them. You never know where your next deal may come from one of them in the form of one of their assets they're looking to sell, or some situation that they're aware of. So those are all the ways to fill your top of funnel. Now, as you proceed to the next step, once you've looked at a deal, it meets your buy box, that is, it meets your criteria for the deals you'll look at. Now you're moving into your first pass underwriting. And as I mentioned at the top of this video, really that's going to be, a high level look at the deal and whether or not it's anywhere close to penciling. You're going to need 3 pieces of documentation in order to do this first pass underwriting. The OM, or offering memorandum, which is really, it's a glossy piece of marketing material that's put out by the broker. It's going to have a ton of information about the property, about the market. It's going to have some financials in there, some rent comps, some sales comps, just a ton of information that the broker puts together in order to provide you as a potential buyer with as much information on the property as possible. So these are really great to get up to speed, and you definitely want to read these for the first pass underwriting, but you don't want to put too much stock in any of the numbers or financials that are provided in that OM. You really want to do your own numbers off of what are the primary documents in this case, the T12 and the rent roll. The T12 is simply a trailing 12 months P&L or income statement. So it's going to show all of your income, the rent, the other income. It's going to show your expenses, all the OPEX categories, and then typically it'll show your NOI as well. And that's going to give you a pretty good idea of how the property has been run in the last 12 months, and maybe give you some ideas as well about areas that you can maybe take over and take on as you buy the property potentially that you can improve. So whether it's collecting more in income or, decreasing your expenses, this is going to be kind of the first step to identifying those places. Next is a rent roll, and that's really going to be a document that shows you who lives where, in which units, and what do they pay, as well as sometimes they include, are there any balances there? You're also going to get a ton of information about the lease itself, as far as when the lease start was and when the lease ends. So that'll tell you if you're going to go purchase a property and it's January when you're expected to close, and you expect there to be 60 to 70% of the units whose leases are ending in the next month and a half, you know that there's going to be a ton of leases when you take over the property that you're going to have to turn over. So it's a really good source of information as far as planning the first year of takeover. Now, I have to add a caveat here. You're not going to take an exhaustive look at these documents at this point. You're not going to be combing through all of these and spending a ton of time on them. They're really just to gather some high-level numbers so that when you do your first pass underwriting, you have enough to get started. You're going to start to really utilize them a lot more as you do your deeper dive underwriting if this deal clears your first pass. You're just going to familiarize yourself with them and really point out anything that may at first glance really stick out to you on these. And then you're actually going to do the underwriting. So once you've combed through the offering memorandum, the T12, the rent roll, now you're going to start to put together some of your own numbers as far as how you think the deal could perform once you take it over. And again, you're not doing a ton of research. I mean, for our first pass, they typically take around a half an hour or so per deal, depending on the complexity of the deal. And you're really asking yourself, does the deal have potential? At this case, this is really you're at the top of the funnel still, really. So you're going to be looking at a ton of deals on the first pass. So you want to be able to filter out these deals as quickly as possible. That's really the aim of your first pass underwriting. It's not to identify whether or not it's a good deal or not. It's really to filter out the ones that you know for sure are not good deals. So this is where repetition gives the skilled underwriter an edge. You can use things like a rule of thumb and systems and technology to be able to do that filtering out of deals. Some of the rules of thumb that we use are expense ratios, and we go ahead and use expense ratios. You may be familiar with them, but basically what they do is they compare the operating expenses to the income. So you may have in the multifamily space anywhere from kind of 30 to 60% expense ratio is the range that we see, depending on the size of the asset, the age, and how well upkept it is. And then typically that expense ratio you can use to multiply that by the income that you expect to receive and come up with an NOI, and then you can compare that to the purchase price. So for example, if you have an NOI of 50,000 and your purchase price is $1 million, your cap rate is going to be 5%. Now, that rule of thumb that you use to arrive at 5%, you're going to compare that 5% to the prevailing market cap rate. If the prevailing market cap rate is 7%, and this deal just at first pass is around 5% using the expense ratio rule, then you're not going to be anywhere close. You may not choose to move forward. Also, OPEX per door per year. We may use the same kind of methodology for that in order to come up with a going in cap rate. That is, what is the property producing in terms of cap rate today. So if you know that you need to spend $5,000 a door per year and you multiply that by the number of doors, then you can subtract that from whatever you expect the income to be, and you're at NOI. You use that to compute the cap rate, and then you compare that to the required cap rate that you have or the prevailing market cap rate in the market. So again, the same rule of thumb kind of applies there. If it's lower than the prevailing market cap rate, it's too far lower. That is the differential between what your cap rate is from these rules of thumb and the prevailing market rate, then you may not be willing to move on, and it doesn't pass the sniff test, and you kind of end it there. But the main thing with this is, as you get more and more repetitions in of doing these first pass underwritings, you'll develop these shortcuts to be able to really filter out deals. I know in the residential space, something that was very common years ago in a different interest rate environment was the 1% rule, where if you're bringing in $1,000 of rent, you'd expect that property to be priced at $100,000 or less. That is, you're taking in rent that's equal to 1% of the purchase price or more is the goal, really. So these are just all examples of rules of thumb. It doesn't necessarily make a good deal, but it definitely can tell you whether or not there's any chance of the deal penciling. Now, as we take a step back, everything that we've talked about is the calculation. We kind of want to look at this from a 30,000-foot view. What you really want to have is a system for managing deal flow. Now, it's very easy as you're starting off, when you have maybe 1 or 2 deals come across your desk every week, for you to kind of take them an as-come basis. But as you get more and more deals coming across your desk or in your inbox, you really want to get a system for managing that deal flow and keeping track of all the different various stages that the deal goes through in this deal funnel. And then finally, as you rule out these first pass underwritings, or even as you decide that it's worth a deeper dive underwriting, you want to get back to the broker with that feedback. You always want to get back to the broker with that feedback. So whether you're way off, you're 20, 30% off of the purchase price on your first pass underwriting, you want to go back to the broker. And that really helps solidify a track record with the broker. Believe it or not, how you treat the communication during this phase is how the broker is going to assume that you're going to treat communication during the closing process. And also, by providing them that feedback, it actually can serve them and actually can be a little bit of a benefit to them when they're communicating with the seller. Let's say that you're way off and it's because your repairs and maintenance you're expecting to incur on this property is much higher from what you've seen in the market or other properties you have. If you get back to the broker with that information, maybe the broker is able to pass that on to the seller. And you never know, if they hear enough of the same thing from multiple different investors, sometimes they'll take that in consideration and actually mark down the property. We've seen that in cases. So besides that, by the broker going back to the seller, they're also demonstrating to the seller that they're very active and they're actually doing their job, which again, you help the broker look good. Ultimately, it's going to reflect very well on you. So now kind of what does our MCP deal flow system look like? And this is a snapshot of what our deal flow looks like. Starting from the far left going right, it's basically every one of those columns is a different phase of the deal funnel process. So the first pass you could see there, then you have the broker follow-up. You also have the deep dive underwriting there, the LOI, and then hopefully you get under contract from there and close the property. Now we have a deal graveyard column there and then a sold column there if it sells to another buyer. The deal graveyard column is really a bit of a misnomer because that's not where necessarily deals die. We are following up on those deals until those deals eventually trade. So one thing that's common in our space is that there will be a buyer, let's say, that gets under contract and something they figure out along the due diligence process or something with the financing doesn't work out, and suddenly that deal is on the market again. You want to be the first to know that a deal is not closing or a buyer is not performing. And oftentimes, if you're following up on a consistent basis with the broker on these deals, and the deal falls through, immediately, if they know that you're interested and you followed up, you may be one of their first calls that they give when that deal doesn't cross the finish line. So that's why follow-up is really key in this business. Now, the next step, we're not going to cover in this video. It will be a part 2 video, but we're going to really go into the deep dive underwriting. We're going to talk about how we do a deeper dive underwriting with a specific example. We're also going to be looking at what are some of the return metrics that we use to really come up with what is our price that we're willing to pay for a deal. And then eventually, what does that offer process look like with the broker in terms of your LOI, your letter of intent? And then finally, hopefully of those offers, you're able to close a pretty high percentage of those. So we'll talk about that and more in our video number 2 of this video series. So we hope that you've taken away a bit of information about how to improve your deal funnel process. Please, if you have any feedback or you have any ideas about how we can improve our process, we're all ears. We by no means have a monopoly on this process. And to the extent that we've created this process in any way that's helpful, we've really done so from the advice of others in this space that are more experienced than us. So really appreciate your time. Hope you've learned something, and we'll sign off as we always do at Maple Capital Partners. Be kind, be charitable, and invest wisely, folks. Thank you.